Imagine a vast, invisible landscape where billions of dollars move at the speed of light. Here, fortunes are birthed in a fraction of a second, and empires crumble before the sun sets. For centuries, humanity has sought the ultimate vehicle for survival, a way to turn today's labor into tomorrow's freedom. In one corner, we have the great intangible, the stock market, a digital ecosystem of ownership and innovation. In the other, the great tangible, real estate, the ancient, unyielding earth beneath our feet. Today, we peel back the layers of this financial rivalry to answer the question that has defined modern wealth: which is better? The story begins with the numbers, the cold, hard mathematics of growth. For over a century, the S&P 500, the heartbeat of the American economy, has yielded an average annual return of approximately 10%. It is a system of incredible efficiency. Through giants like Vanguard and BlackRock, any individual with a single dollar can own a piece of the world's most powerful corporations. It is frictionless. It is transparent. With a click, you are an owner. With a click, you are liquidated. But this speed comes with a price: volatility. The stock market is a sea of jagged peaks and terrifying valleys. It is a place where the collective psychology of millions can turn on a dime, wiping out billions in perceived value in an afternoon. But there is another path: real estate. It is the only investment you can touch, walk through, and call home. While a house might only appreciate at 3 to 5% annually, half the rate of the market, it possesses a secret weapon: leverage. In the world of property, the bank provides the fuel. With a 20% down payment, you control 100% of the asset. When the property value rises, you don't just gain on your investment, you gain on the bank's money too. This, combined with rental income and the unique tax shields of depreciation and the 1031 exchange, creates a wealth-building engine that the stock market struggles to match. Yet, this path is not without its predators. Today, the landscape is shifting. We are witnessing the rise of institutional giants like Blackstone and Invitation Homes. They are moving into the neighborhood, buying up single-family rentals by the thousands. Critics argue this is a displacement of the American dream, a corporate takeover of the very soil we stand on. Furthermore, the barrier to entry is rising. While you can buy a fractional share of a tech company for the price of a cup of coffee, the door to real estate is becoming heavier. It requires significant capital, sweat equity, and the stomach to handle the 3 T's: tenants, toilets, and trash. And then there are the bubbles. The air is thick with tension. In the stock market, critics point to an artificial intelligence hype cycle, wondering if we are inflated by nothing more than digital dreams. In real estate, record high prices are colliding with the iron fist of the Federal Reserve's interest rates. We are standing at a crossroads. Is this a new plateau of prosperity, or are we repeating the mistakes of 2008? So, where does the truth lie? The world's greatest investors rarely choose a side. Warren Buffett, the oracle of value, champions the long-term stock index. Meanwhile, voices like Robert Kiyosaki preach the gospel of cash-flowing assets. The reality is that these two titans are not enemies, but partners in a sophisticated dance. Most experts now suggest a core and satellite approach. The stock market provides the core, the liquid, passive engine for retirement. Real estate serves as the satellite, the tangible hedge against inflation, the fortress of tax efficiency. There is no objective winner. There is only the investor. If you crave the ease of the digital age and the speed of innovation, the market is your theater. But if you desire control, if you want to build wealth you can stand upon, then the earth is calling. In the end, the best investment isn't a ticker symbol or a street address. It is the courage to begin.